Okay, so we're going to do number 40. So Spritz Company ordered merchandise from a foreign supplier on November 20th. So here's a keyword, they ordered it. They didn't buy it. So I'm thinking in my head, probably a firm commitment. On November 20th at a price of 1 million foreign currency units, when the spot rate was 0.50, so I add that there on November 20th. So write this down as we go along. Delivery and payment were scheduled for December 20th. So notice it's delivery and payment. So title passes on December 20th, so this is a firm commitment because title didn't pass when I signed the option. They acquired a call option for 100,000 foreign currency units at a strike price of 0.50, paying a premium of 0.01, so that's what I'm paying for it. And the fair value of the firm commitment is measured by referring to changes in the spot rate. So notice this is my spot rate, and I'm going to do the firm commitment following the spot rate. Notice usually in a firm commitment where they have a forward contract, they follow the forward rate in the firm commitment, but with an option you don't have a forward rate, so we're going to use the spot rate. And so the merchandise arrives and Spritz makes payments according to schedule. They sell the merchandise to somebody else on December 31st when they close its books. Okay, so we're going to make those journal entries, and notice that A has the spot rate at 0.53, and then in B I'm going to change this 0.53 to 0.48. We're going to see what happens there. Okay, so let me pause this. Okay, so I got the solution up here. So I'm first going to fill this out. Please ignore this because they've put part B in there too. But notice I have 0.50 and 0.53. My strike price is 0.50 and it says I'm buying it for 0.01. So now I need to do my fair value, intrinsic value, and time value. I asked myself the question, well, first of all, I get my fair value, which is 100,000 times 0.01. So remember, I have to buy an option, so that's what I paid for it. Now I figure out the intrinsic value. Would I rather buy it for 0.50 or 50? Well, I'm indifferent, so its intrinsic value is 0. Therefore, its time value is the 1,000. So intrinsic value plus time value equals the fair value, so I can back into the time value. Now I'm going to go to December 20th and do the same thing. Notice I not given a value there or there, but I can do my intrinsic value. Would I rather buy it for 50 or 53? I'd rather buy it for 0.50. So my intrinsic value is 0.03 times the 100,000. So my intrinsic value is 3,000. Let's put 3,000 in there. Okay, my intrinsic value is 3,000. I know that the thing is settled on the 20th because that's when it finished. So on the 20th, the settlement date, the time value has to be 0. So 3,000 plus 0 will give you the total fair value, so it's $3,000. Okay, so you can see that's what they have here, although it's going to be confusing when they have the part B also shown there. Okay, so let's go to the journal entries. On 11/20, notice I buy inventory, but if you go back to the problem, they haven't bought it till December 20th. They've just signed an agreement here. And so there is no entry on the regular side. So put no entry, only a purchase order has been signed. All right. However, on the option side, I had to buy it for $1,000. So I debit foreign currency option in cash. All right. Then the next one, I need to adjust my regular side on the 20th, but again, title hasn't necessarily passed yet, so let me go over to the option side, then I'm going to back up. I need to make my option go from 1,000 to 3,000, so I need my option to go up. So I debit my option, that's this one. So this is on the option side, my hedge side. So on the hedge side, foreign currency option, gain on foreign currency option, so that's 2,000. Now, if you go back and read the problem, it says the firm commitment is adjusted by changes in the spot rate. And the spot rate went from 0.50 to 0.53. So 0.003 times 100,000 is 3,000. So that's where they get this. Okay? So now one kind of easy way to do it is if I have a gain on this side, I generally have a loss on this side. All right, so over here, pretend if you had not hedged. If I had not hedged and I bought it on November 20th, I would have had to pay 0.50. If I had not hedged and I had to pay for it on December 20th, I would have had to pay 0.53, so I would have had to pay more. So it's a loss, all right? I'd rather have you understand why it's a loss, but generally speaking, you're going to guess it's usually going to be the opposite of that, although there could be instances where it's not. All right, so here's my firm commitment right here, so I'd write it on the regular side. Okay, notice the amounts don't equally offset because the firm commitment is changing by the spot rate at the same thing that my accounts payable would have changed for, because in this one I bought inventory. All right, now I'm going to settle the thing. Okay, so I'm buying inventory, so first I need to buy foreign currency. Now I want to ask myself, do I want to buy it for 0.50 or 0.53? Well, I'm exercising my option, so I'm going to buy it for 0.50. So I'm debiting foreign currency, but let's take the cash first. I'm paying 0.50 for it. But my foreign currency is worth 53.53, and my option should be sitting at 3,000, and it is right here because I've adjusted it to 3,000 there. It was at 1, I added 2 more to it, so it's now sitting at 3,000. And so these should all just balance with the foreign currency option. Then I get my merchandise inventory and pay for it with a foreign currency. So I'm going to clear that, and I want you to ponder that and practice it a little bit before we go back and we change this to 0.48. I believe that was what it was. Okay, so now I'm going to buy it for 0.48. Now let's go through and fill this out again. Delete that. Okay, so I paid 0.01 for it, so 100,000 times 0.01 is 100,000. Now when I go to December 20th, I know my time value is 0 because that's the settlement date. So now I'm going to fill in my intrinsic value first. Would I rather buy my foreign currency for 50 or 48? And the answer is I'd rather buy it for 48. So this intrinsic value is 0. It cannot go below 0. So 0 plus 0 is 0. Okay? So part B, I think I forgot these entries in part A to finish the thing. So I went ahead and sold my merchandise. I'm not really sure why we didn't put the accounts receivable sales there, but cost of goods sold, merchandise inventory, and I need to get rid of my firm commitment, take it to adjustment in net income. Notice that a lot of people take it straight to cost of goods sold instead of inventory. So there's your impact on net income. I have my firm commitment, etc. All right, next one. What happens if it goes to 0.48? So again, on 11/20, I have no entry on the regular side because all I did was sign an agreement. I bought the foreign currency option for $1,000 in cash. Then on the 20th, I need to adjust my foreign currency option. I'm going to this one right here. I'm going to do this one first. Okay, I need my adjustment on my foreign currency option to go from 1,000 to 0. So now notice that I just basically take it off my books because the thing is worth nothing. Nobody wants it because we can buy foreign currency for 0.48 on that date instead of 50. So basically, this $1,000 I paid for it is ending up as a loss because I didn't use it. But remember, still, I entered into it so I wouldn't lose more than $1,000. Okay, and so my option is at 0. Okay, and then I said my firm commitment is going to follow the spot rate. So again, go back and read it if you don't remember that. All right, so notice it's 0.50 and 0.48 is 0.02. So 0.02 times 100,000 is 2,000. All right, so again, generally speaking, if a loss is on this one, a gain is on this, although the numbers don't offset. So I have a gain on the firm commitment, and so you can ask to yourself, well, gee, if I paid it off here, I would have had to pay 0.50, but if I paid it off here, I'd have to pay off less, 0.48, so I have a gain. So you can think of it that way. All right, now I'm going to settle my transaction. So let me clear that. So move it up. So I settle my transaction. I need to buy my inventory. So if I buy my inventory, I have to buy the foreign currency first. I have the option to buy it for 50 or 48. I'm going to buy it for 48 and not use my option. So I debit my foreign currency. Oops, didn't mean to go. That's this dividing line. Debit my foreign currency and credit cash, buy it for 0.48. Notice I don't have to do anything with the option because my option is down to 0 now from my last journal entry. So I put 1,000 in and took the 1,000 out. My fair value of the option is 0. I get my merchandise inventory. I sell it by December 31st. I'm not necessarily sure that they asked for this journal entry. And then I need to also get rid of my firm commitment, which is sitting at $2,000. And you can feel free to debit cost of goods sold on the exam. It's just would be inventory or cost of goods sold whenever it's sold. But a lot of times these are immaterial, so you just take it to cost of goods sold. All right, so I'm going to clear that. Get that off there. And so you can see the impact on net income is I have a gain, a loss on the option. I think that's misleading again because they don't record the sales. They just do the cost of goods sold and the $2,000 adjustment. So if you take off that $48,000, you've basically got a $1,000 loss there, etc. So the net cash outflow is what I paid for the inventory plus what I paid for the option of $1,000. Hopefully that helps.